So now we talk about common and preferred stock. The purchase of a common or preferred stock represents ownership, stake in the company, which means that when you buy a share, you're buying a part of the company. The return of your investment is tied how well the company does. If the company performs well, does a lot of sales, a lot of revenue, a lot of profit, and overall there's a positive image of the product and consumer confidence is high, then the share price will probably go up. With an investment in a corporate bond, there are other factors such as interest rates. They have a big impact on the value of the investment. But in shares, it's more tied to the performance of the company. However, as a creditor of the company, the bondholders are given first priority if the company goes bankrupt. So why do investors buy common shares and why people select this type of investment? We're going to talk about that. There is potential for capital appreciation with common shares. That means if you buy cheap, low price, you can sell it for a higher price once it goes up. But when you are selling, your profit will be taxed as capital gain. The common shareholders have the right to dividends. They get dividends from the company at the year end when the company declares a dividend, and it is a share of the profit. And if this dividend is coming from a Canadian corporation and they meet certain criteria, the dividend would be eligible for the dividend tax credit. There are voting rights, also voting privileges. If you buy shares in a company, you have the right to go to their annual general meeting and vote for the directors and make decisions about the company generally. Limited liability means that if the company goes bankrupt, you as an investor are not liable for the debts. You're only liable for you're only going to lose your investment, but you do not have to pay for the company's loans or other liabilities. Marketability. So common shares are marketable, meaning you can sell them on any business day and you can buy them also on any business day. The money is not locked in the case of common shares. Preferred shares are the other type of shares or stocks, and they're called preferred because they have a preference before the common for dividends. So that is one preference, that when the company makes a profit, first they have to pay the preferred shares and then they pay the common shares. And also, in the case of business failure, preferreds rank ahead of common shareholders. So if the company goes bankrupt, first the bondholders get paid because the bondholders are secured. They have a security. The company has pledged its assets based on the bondholders. So they are paid first. The bankruptcy trustee will probably sell the assets of the company, and that money will be used to pay the bondholders. Then next come the debenture holders. And once the debentures holders, which are unsecured creditors, once they are paid, then the preferred shareholders are paid. And then if there's money left over, the common shareholders then get their share, which is very little chance. Usually when a company is going bankrupt, the common shareholders are not going to get hardly anything, and the value of the shares would have gone down, and there would not be enough assets left in the company to pay the common shareholders probably. So why do companies issue preferred shares over debt? Because there's no contractual obligation to pay the dividend. The company can skip a dividend, although it gives a bad impression, but they can do that. And there's no maturity date for the preferred shares, and there's greater flexibility for the company. And companies prefer to issue preferred shares over common share because the preferred shareholders are only entitled to a fixed return. It's not dependent on the company's performance. There is a par value, and based on the par value, the company calculates how much dividend they will pay. And there's no dilution of control. Most of the preferred shares are non-voting, so companies prefer to issue those. So why do investors like preferreds? As we mentioned, cash flow. There's a tax advantage in the dividends, and there's preference in dividends and assets on wind up. But the dangers of preferreds are there's a purchasing power risk. And if there's an increase in the interest rates, the preferred shareholders are going to see most probably their value of the shares go down because they behave just like bonds. That just like bonds we mentioned, if interest rates go up, bond prices go down. These are also, preferred shares are also fixed income type of security, and so they will be affected by interest rates. Dividends could be passed over. Possible the company may skip a dividend. There's no guarantee, and the company could also fail. These are the different types of preferred shares. The straight preferred shares is the normal type of preferred share, which has no end date. It gives a fixed dividend. The price falls if the market interest rates goes up. And these may be cumulative or non-cumulative. By cumulative, we mean that if they miss a dividend, they will make up that dividend before they pay the next one. And non-cumulative means that if they miss a dividend, the company will not make up that missed dividend. Then there are convertible preferred shares. The convertible ones can be converted to common shares of the same company, and there's a fixed conversion price. Then there are retractable preferred shares. In these ones, the shareholders can force the issuer to buy back the preferreds at a fixed price. And then soft retractables, the value may be paid in common shares or in cash. Floating rate or variable rate preferreds, the next one, their dividend depends on interest rates. If interest rates go up, their dividend will go up, and vice versa. Foreign pay, they pay the dividend in foreign currency like US dollars. Participating preferreds, they may get an extra dividend. And deferred preferreds, they mature at a future date. They are sold at a discount and mature at par, and there's no dividend tax credit. So deferred preferreds are similar to T-bills or strip bonds in that buy them at a discount and they will mature at the par value. This is an example of an equity securities preferred share. And the value of the preferred share is also known as the annual yield or the yearly dividend. And that is calculated as dividend divided by current market value. So the value of the dividend divided by the price times 100. This will give us a yield, annual yield. So this example is for Nova Scotia Bank. It's $25.43 on December 3rd, 2021. This shows the previous day, working day, it closed at 25.55. So on December 2nd, on Thursday, it closed at this price. And in one day, it fluctuated in this range. In 1 year, the prices moved up from 21.94. It's now at 25.43, but it was even high as 26.10 in the 1 year. Volume is the number of people buying or selling the shares. Beta is an indication of how risky it is. What is the volatility? Beta of 0.84, we will discuss in the next chapter, but that means that if the market index goes up by 10%, these shares are expected to go up 8.4%. And if the market index goes down 10%, these shares are expected to go down 8.4%. PE and EPS are two ratios for value, price earnings ratio, earnings per share. We will discuss about these in the next chapters. And this here, we're talking about more focusing today right now on the forward dividend and the yield. So what is the dividend? 1.21 means $1.21. This is the dividend for one share, and this is the dividend yield. Let's take a look and see how they calculated it. So $1.21 means that the $1.21 per share, and the share price we know is 25.43. So what is the dividend yield? From this formula, we said what is the dividend? It's $1.21 divided by the market price. The market value is 25.43 times 100 will give you 4.75%. And that is what is given here as 4.75%. So if someone has 100 shares means $25.43 times 100. They're spending $2,543 for these 100 shares. Now the dividend here, the dividend ex-dividend date is December 31st, 2021. On that date, whoever owns the shares on that date, they will get the dividend. So it's not a good idea to sell your shares a few days before the dividend date. Otherwise, you're not going to get that dividend. So on that date, if you own the dividends, you will get the dividend, and it will be calculated as, they said $1.21 per share. And if you have 100 shares times $1.21, you will get $121. Or you can calculate what is 4.75% of 2,543, which is my investment. So that also is going to be the same, $121. Perpetual preferred shares, what is a reasonable price? So since the preferred shares have a fixed dividend, the formula for determining what is the value for preferred share, it's similar to that of bonds. In the case of a perpetual preferred share, the lack of maturity date. So perpetual one does not have any future date. So the formula is going to be dividend divided by IP. What is PP? That is the market value of the preferred share. What is the market value? That is, what is the price that it should be trading at? So let's suppose we know what the, so example, let's take a look at this example, $25 par value, and it's paying 8% dividend. So what is 8% of $25? That is $2. So we know it's paying $2 dividend, which we put here at the top of the formula. And we know that the yield on similar preferreds is 10%. So $2 divided by 10% is 0.10. That is $20. It means that the value of the shares should be $20 or lower. If it is lower than $20, it is a good buy. If it is higher, it means it is expensive based on the dividend yield.